Now we can talk to Simon Grose-Hodge. He's the head of investment strategy for South Asia at LGT Group in Singapore. Thank you so much for joining us. Now, in terms of what we have been hearing, you say that there's too many investors wanting China to rush into this. You think they'll take their time in raising interest rates?
Yeah, that's right. We think the market is really exaggerating the amount of tightening we're going to get over China. Everything you see out of the policymakers, maybe even tightening is the wrong word. What we're seeing is a removal of the previous accommodation back to a more neutral standing, or prudent as they tend to call it. And that's a long way from actual monetary tightening. We don't think they're trying to do anything more than the slightest tap on the brakes. They're just trying to make sure that there's no overheating, that they don't run into asset bubbles. And if you look at the policy and what they're trying to do, rather than go with sweeping broad interest rate increases, they're making very selective policy decisions. They're going after the areas where they think there is some overheating, and that's the bank loans, the property developers. They're very much trying to make sure that the overall economy stays in an expansionary mode, and they just put in some of that selective tightening where it needs to be and keep the overall expansion alive and well through next year. On that basis, we think the sell-off in the last couple of months has been too steep, and we're still quite constructive about Chinese equities.
Yeah, and Simon, you also actually make the point that fiscal spending will be a mitigating factor to ensure that growth doesn't slow too much. But I want to see what your take is on this new lending measure. It seems that China will aim for at least 7 trillion yuan of new loans for next year. Does that seem like a small amount?
No, I think that backs up our point. Most of the analysts in the market have been looking for a steeper reduction in bank lending, more like the 6.5 trillion type of region. To be 7 trillion for next year, that's a very small decrease from the 7.5 trillion for 2010. So again, we think that really falls into the category of still wanting an economic expansion. There are other targets like 8% growth and 4% inflation, both probably a little bit too conservative, but all of which point to us that said they're merely just, this is just a mere tap on the brakes. They're still looking for fairly decent expansion next year, and we believe that you just need to follow what the policymakers are telling you. They're looking to boost domestic consumption, they're looking to make the domestic economy stronger, and we think that's the best play in the equity markets. Go for those consumer-related stocks based on that domestic demand. And
so you're also saying, Simon, that actually policy is moving from an accommodative stance to actually neutral one. When are we going to see rates tighten?
Well, there's no question they are going to have to raise rates a little bit, but again, analysts in the market, some of them looking for as much as 100 basis points in the next 12 months. We think that's far too much. We predict really that the inflationary aspect, particularly from the food prices, that's going to be topping out fairly soon, perhaps by the half of next year. And on that basis, the last thing they want to do is to tighten too much and then be faced with actually having to ease again as those numbers start to come down. So we think at least one for sure, maybe only 2 interest rate increases in the next 6 months. Then you'll start to see those inflationary numbers coming down. And if you also look at other policy, they've capped the coal prices for contracts into the power stations. That makes sure that energy prices won't rise too much more. And they can also cap food prices, again, making sure that that inflation doesn't get out of hand. Those selective policies seem to be what they prefer over and above a whole raft of interest rate increases. So again, we think the market view is exaggerated on that fear.
Yeah, you believe that they are really targeting problems. Simon, thank you so much. Simon Grose-Hodge there.